I'm going to talk through a bunch of different examples that you can possibly put your money into tonight, as well as give some examples of the kinds of returns you can get. My name's Tomo, welcome to the live stream. Please keep in mind I'm not a licensed financial advisor, so this video is for educational purposes only and entertainment purposes only. Make sure you do your own research and choose the best option for you. Now, the very first thing you can do is the most boring old bank account. If you've got a little bit of money and you leave it in a bank account, what kind of return can you get on your investment? And I'm going to talk through some of the pros and the cons here. So bank accounts, some of the pros is that you have access to that money instantly. You can put money in, you can take money out. There is no penalty for doing so. That's one of the benefits of a bank account. Some of the downsides is it's one of the lowest rates of returns you can get. You never heard of anyone getting rich by leaving money in a bank account. So I've just got a comparison site here. Be careful of these sites because they are just sales tools, but this will help us for our examples tonight. As you can see, some of the highest rates on a regular old bank account is 5%. We've got 5% here, 4.3% on Suncorp. Now the catch with leaving your money in a bank account, to get this bonus interest rate or to get this high interest rate, you normally have to jump through a few hurdles. You normally have to follow a few steps. So the first one, earn a high interest rate of 5% per annum for the first 4 months. Then it drops down to 3.45% thereafter. For the second one, you got to deposit so many $200 a month by the looks of it. And there's normally always terms and conditions to get these interest rates. So it is the easiest to do, putting your money into a bank account, into a high interest bank account. The pros are you can get your money whenever you like. You can get access to that money. The cons is you're not going to really earn too much. So that's the lowest form of return that you can get, leaving your money in a bank account. The next step up is what's called a term deposit. And what a term deposit is giving your money to a bank, and that money is locked up for a period of time. So we're moving up the pyramid of returns, but also we're losing a little bit of access. Having your money locked up in a term deposit normally means there's a penalty if you want to get your money out of the term deposit. So it gets locked up for a little while, but you get a little bit of a better interest rate. So for term deposits, you can see the rates here. Some rates were 3.75% at Greater Bank, 3.9%. This is on a 3-month term deposit, and it goes up a little bit higher for 6 months. 10 months, you can set the period that you like. So a little bit fairly similar. Actually, it's actually less of an interest rate than the term deposit, but than the bank account rather. But there's less hurdles to jump through with a term deposit. You simply give the money to the bank for a period of time, it gets locked up, and then you earn interest on your money for that period of time. So that's the second level, term deposit. The next thing that you can possibly think about doing your money is invest in what are called bonds. Now, bonds are essentially debt. They're essentially loans. So with the bond, a common terminology that's used is a coupon rate. And the coupon rate is simply an interest rate. Now, if you buy a bond at the start, at the very, very start, hold it all the way through its life, and then reach the end, you will always get your principal back. And then you won't always get it, depends what kind of bond you buy. But generally speaking, you get your principal back, and then you earn interest repayments along the way. How does this differ to a term deposit? As I said, you can normally trade these on the market. So one of the lowest forms of risk in bonds are what are called government bonds, issued by the local government. So Australian government issues local bonds, and some of the rates kind of vary, but you'll see here there's coupon rates, and we've got 2.75%, 1%, 4.25%, 2.75%. So still fairly low returns, but it's very, very low risk. You would only not get your money back on a bond if the Australian government effectively defaults. Very, very unlikely to happen. Could possibly happen, but very, very unlikely to happen. So these are considered to be quite safe investments, which is why it gets a much lower interest rate. Now, as I said, these are tradable on the open market. But if you buy a bond at the start, hold it all the way through its life, let's say a government bond. So you buy a bond for $100, go all the way through its life, you'll get your $100 back. You'll get your principal back, and you also earn interest on the bond during that time frame. Now what will happen is if you don't buy it at the start and you buy it somewhere along the lines, if you buy it on the open market, you don't buy it when the bond is issued, the price will fluctuate. And the price fluctuates depending on how many interest repayments there are left to go on the bond, as well as the general movement of interest rates. So if you buy a government bond and say it's a coupon of 4%, and then interest rates more broadly drop, then your bond is more valuable because you have a bond, you have an instrument that's paying higher than what the interest rate is at the moment. So it is quite complicated to do all those sorts of calculations, but basically the reason why I bring that up is if you buy a bond at issue, hold it all the way through, you get your money back, you get your interest rates, generally speaking, if it's a safe bond. The price will fluctuate if you buy it in between, which is not at issue date. So how do you actually buy bonds? How can you buy government bonds? There are things called ETFs, exchange traded funds. Normally to buy a bond directly when they're issued, especially Australian government bonds, you need sometimes tens of thousands of dollars, if not hundreds of thousands of dollars to buy a bond at issue. For beginner investors, for new investors, that's not always viable, that's not always realistic. So one thing you can do is buy an exchange traded fund, an ETF, and that ETF buys Australian government bonds for you. So I'll just show you an example. Again, this is not any recommendation, but this is one particular beta shares bond, AGVT, and you'll see the kind of returns that we're looking at, 3.9, 4.9%, those sorts of things. So that's basically, and it's showing you here what government bonds that it holds. Now the price of this instrument will fluctuate because it's tradable on the open market. But again, in terms of risk, government bonds are considered one of the safest investments. You only won't get your money back if the bond fails. Now, next level up from that are straight corporate bonds. Australian corporate bonds. Australian companies have gone out there and they've issued a bond to the market, which means that they're borrowing money for people, and then you can buy those bonds. Again, you can buy them direct on the open market. You normally need a lot more money to do that. You can't do that with like a couple $100 normally, or $1,000. Or you can buy ETFs that buy corporate bonds. Now, with a corporate bond, the risk is starting to increase a little bit. Whereas, you need the Australian government to default if you're going to lose your money on an Australian government bond. For corporate bonds, you just need to have the bond fail. So sometimes a business can fail, and the company can't pay that bond back, or sometimes the bond itself can fail. So what I'm trying to say here is that the risk is gone up a little bit, and because the risk has gone up, you should be compensated for that risk, and so you normally are offered a higher return. Increased risk, higher return. So when we're talking about corporate bonds, I've just pulled one up for the sake of an example. These are some different ETFs that track corporate bonds, and these are some of the returns. So you can see we're now going a little bit higher with some of the returns. We started off at 5%, but on bank accounts, we have to jump all through all these hoops to get the interest rate. Next, we moved to term deposits, about 4%, but your money's locked up. Next, we moved to government bonds, about 3% or low, but you can trade those instruments. Now we're in corporate bonds, so the rates are a little bit higher again, but you are at risk of losing a little bit of money with these items, purely because you're relying on if the company's is going to succeed or fail. And then you can buy bonds for big companies, you can buy bonds for smaller companies, and your yield will change accordingly because of that. So those are bank accounts and bonds. Next, we're going to talking about investing in the stock market. It is really, really easy to invest in the stock market nowadays. Anybody can invest in the stock market. All you need is simply an app on your phone. And what is really, really a great graph that I like to bring up around the stock market. So the stock market is a little bit expensive at the moment. I've made another video on that. I'll leave a link in the description. But what's really important to see, just bear with me one moment. If you have, so these are the returns of the Australian share market for the last 124 years. If you have a short-term time horizon, you're looking to invest in the next couple of days, in the next couple of months, and sell really quickly and realize those gains. Short-term time horizon, it's very, very hard to beat the market. Excuse me. If you have a long-term time horizon, your returns generally follow the returns of that market. So this is the Australian share market. I don't know if you can see this little text up the top here. The average return, this is the average return. Average return over the last, since 1900, is 13% per year. 13% per year, that's not too bad. Now some years are obviously much higher, some years are much lower, but the average is 13%. There are obviously green years. All these green years stacked up here are all the positive years that the stock market has had. And all these red years are the negative years that the stock market has had. So you will ride the highs and you'll ride the lows. But overall, the average is 13%. So if you have a long-term time horizon, the Australian stock market could be a viable investment option for you. Let's look at another photo. This is another document here where it talks about, I'll minimize that. So 88%, I've already highlighted, 88% of professional investors were unable to beat the market as a whole. 88% of professional investors were unable to beat the index. Let's have a look at how the American stock market does over a long period of time. So this is a graph showing the S&P 500 over the last 151 years. Now, the majority of institutions educate and guess that your return for the S&P 500 is between around 10 to 15% over the long term. That's a well-documented number. And look at all these green, so this green row here, which is the highest row here, are returns between 10 and 20%. Again, some years are higher, some years are much lower, but with a long-term view, a long-term time horizon, the average return is between 10 to 15% per year. That's pretty good. And you saw the picture I showed you before, 88% of professional investors are unable to beat the stock market, are unable to beat that index. So if you're for a beginner investor, just coming in a little bit of money, why even try to beat the index? One possible option that you could do is just buy the index as a whole. And you can do that through things such as dollar cost averaging. I've made a video on that. I'll leave a description below. And one possible option for you to do is buy what's called ETFs. You can buy ETFs that track that total index as a whole. Now, this is the really important part. When should you invest? How long should you invest? When should you start investing? This is going to blow your mind. So let me pull this up. This is a simple compound interest calculator, simple compound return calculator. So say you start off with $100 and say you can afford to invest $100 per week. Take it out of your pay. That's $400 a month, compounding. We can do month, we can do annual compounding. It doesn't really change. And if you start investing when you are 20, so 20, you retire at 65, 45 years. We've just looked at the average returns, 10%. This $100 per week over 45 years turns into $3.4 million when you retire. That's just through the magic of compounding. The key here is starting early. What if you started just 10 years later, in your 30s, 10 years later? So let's change this to, so we've seen this number here, 3.4 million. Let's change it to 35 years and see what happens. It drops to 1.3 million just by starting 10 years later. If you don't start early and you start in your 30s, it drops to $1.3 million. You lose $2 million just by starting 10 years later. What's the key message with this one? Time, said a million times, time in the market, starting early, is much, much better than timing the market. Starting when you're young, building up your investment portfolio, building up your returns can be a viable option, and can be a viable option for you to possibly put some of your money in if you want to build wealth, if you want to grow wealth. That's really, that blew my mind when I did that. 45 years, change it to 35 years, you lose $2 million just by 10 years. That's absolutely crazy. Hope you enjoyed the video. We've gone from low risk, low return items from bank accounts all the way up to the stock market. Hope that gives you a little bit more information. Allows you to do a bit of research for yourself on what you want to do with your money if you've come into a bit of money, a bit of savings. I'm Tomo from Tomo Finance. Head over to my YouTube channel and check out some of the other videos I do. I talk all things stocks and growing wealth. Thanks for stopping in. See you in the next video.